Cenovus Energy is acquiring MEG Energy for almost $8 billion, including debt, outbidding Strathcona Resources. Now, this deal values MEG at $27.25 per share. Some of it, of course, is in Cenovus stock, so that's a moving target. Let's get more from Eric Nutall, partner and senior portfolio manager at Ninepoint Partners. Eric, it's a take under, isn't it? It's less than the price of MEG yesterday.
It depends on how you measure it. You know, they're saying it's a 33% premium to the 30-day VWAP before Strathcona went hostile. I'm frankly disappointed at this price. I think the reason why Cenovus is trading up is that they're stealing this company at $27.25. But unfortunately, I think Adam Waterous, through his opportunism, released the genie from the bottle. Once you do that, you can't get it back in. And so as MEG shareholders, very clearly, we did not want Strathcona paper. It was dilutive by our estimates on every single measure. And so MEG went and shopped themselves. And you know, I'm surprised that there weren't other people to come up and bid for the company. This is an incredibly unique company. It's an incredibly unique asset. And the biggest reason I'm disappointed is that this company was easily on the path they finally, through 2 years of efforts of deleveraging, paid down debt aggressively, and they were about to meaningfully buy back shares out of free cash flow. And so if you use a mid-cycle price, we think the stock would have been worth $40 to $50 given the passage of time. And so $27.25, we've made a bit of short-term money on it, but I really think the money would have been made in the wait. But unfortunately, Adam Waterous's actions made that impossible.
$40 or $50, I know it's hard to be precise, but you think within a reasonable time frame that the market would have valued MEG at a number like that?
Yeah, you've got a company, they have 35 years at a minimum of stay flat inventory. We think at roughly 70, so we think that's a mid-cycle price at some point mid-next year. They could buy back 50% of their shares outstanding over 5 years. And so you'd be effectively getting 25 years of meaningful free cash flow for free. This was a very unique story. And it's at a time when U.S. shale companies are clearly exhausting their inventory. And I think we're on the cusp of an M&A wave in Canada as those companies need to come north of the border. And so I'm really just disappointed in the outcome of the price. I'm disappointed in the outcome of the timing. I'm disappointed of Adam Waterous's actions. He's made a whopping, we think, 12% on this trade. We think their cost base is around 24, and I would expect he'll be monetizing. He signaled that in the 27. So we have a tremendous amount of respect for him, the amount of money he's made for his clients, the contrarian nature that he's built an empire with. But I just think trying to be opportunistic, take advantage of what was then very weak sentiment, and try to take over this company, unfortunately led to the premature demise of what we thought was going to be just a spectacular compounder of meaningful share buybacks over time.
So why wouldn't the MEG board just have dug in and told Cenovus, no, go away, you're going to have to come back with a higher number?
I think they open themselves up to liability if they do that. If they vote down Strathcona and they tell Cenovus to go, take a hike, we did think the stock was going to sell off. In the 27s, we thought a $30 share price was going to be closer to fair value. We never signaled that for obvious reasons, but we thought 30 to 32 is what the company was going to sell for. But if you're at 27 and you reject all offers, very clearly, given that a lot of the stock is now in the hands of merger arb, more, I would say, non-fundamental shareholders, the stock was going to sell off. And so if you reject bids and your share price falls 20%, as a board, you do open yourself up to liability from that perspective. So again, once you go hostile, once a company goes hostile, I think it's very, very difficult to get the genie back in the bottle. And as a result, it's led to the premature ending to what was going to be just a phenomenal, very shareholder-friendly name.
You've told us in the past about MEG and their cash flow. Just give us a couple of numbers.
Yeah, so depending on the oil price, we think oil is depressed now. We're bearish, for the next 3 to 4 months, but we think we'll be in a $70 to $80 plus oil price at some point in the second half of next year. So in that context, when you look at a free cash flow basis, this is a company that could privatize themselves in 10 years, buy back half of their stock over 5. And again, it's that action of meaningful share buybacks that must drive the re-rating in the share price. And this is a name that was doing just fine. And so there was no problem that needed to be solved. They do not have a debt problem. They do not have an inventory problem. It's a very shareholder-friendly board, a very shareholder-friendly management team. But it was effectively one gentleman who has done very well for his clients in the past by being contrarian, taking advantage of a funk in sentiment, and they did that thinking that shareholders would look for the quick win, and again, it's led to a very sad ending for MEG. We've known this company for a very long time. We bought a massive position, the day after Husky walked away at $4 pre-market. We bought millions of shares. We've known this company very long. We've done very well by it, but we just thought that we could have made a lot more money in it, by being patient.
And so it's 100,000 barrels of oil sands production, and that production is magical in the sense that it lasts for a long time compared to, say, a shale well in Texas. So, as you say, it's seen as something of a crown jewel here. It's scarce, this kind of thing.
It absolutely is. I think the scarcity of oil volumes at scale, inventory at scale at a time when U.S. shale production growth has ended. It is no more. The twilight of U.S. shale is a massively bullish impact. And so when you look at size and scale of the world, as companies need to replace inventory, where can you go? The only countries, there's 4 of them in the world that have scale, and it's effectively Saudi Arabia, Iran, Venezuela, and Canada. 3 of those 4 are uninvestable. And so we think that Canadian assets are going to trade at a material premium over time, as U.S. companies don't necessarily want to. They must eventually come to Canada to replace their depleted inventory. And so again, seeing an asset like MEG's, it's one of the highest quality assets in the country. You've got decades worth of state-fed inventory, very low cost, of negligible declines, very capital efficient for a company that had signaled that they were going to meaningfully buy back their shares. And it's just such an elegant way of driving re-rating in that stock over time. To see it come to an end like it is today, it makes me a little sad.
Do you think there will be plaudits here, praise from Bay Street and investors for Jonathan McKenzie, the CEO of Cenovus,
Absolutely.
and then, of course, Alex Pourbet, the chairman, for getting MEG at a decent price, a good price?
100%. I think that's why the stock is reacting well. And I do think from a Cenovus perspective, we don't own the shares today. If you're a MEG shareholder, what you're basically getting is 75% cash. So it's a very large cash component. It does make you, if you own MEG, you're either a merger up guy, you're hoping for a higher bid, or you're bullish oil. So you have to appreciate the mixture of what you're now holding. And I do think the Cenovus bid will go through. This was a heavily shopped deal. I don't think you'll get another a suitor. I wouldn't be surprised if the break fee is quite large. And so for Cenovus, they were on the cusp of getting back shareholders' interest after 2 years of very poor downstream performance. They probably finally put up a good quarter. I think this is a name where energy specialists have been waiting to buy it. I do think Canadian institutions are very underweight energy, and also Cenovus at large, and they've been wanting to buy this name. It trades at a big discount relative to CNQ, to Suncor. We have it trading at about 5.3 times forward cash flow next year at 60. CNQ is over 8, and Suncor is in the 7. So it's been trading at a big discount owing to its downstream challenges. It feels like it's now about to overcome those. And so we just think that investors had been worried that they'd go out and blow their brains out by offering a huge premium for MEG. Unfortunately, as a MEG shareholder, we're not getting that. But for a Cenovus shareholder, I think there's a bit of a relief rally in the name. And this is perhaps one of those final obstacles that they've gotten over to that has been preventing new money from coming into the name. And so I think that's why you're seeing this stock react. And we do see meaningful upside in the name over time. If you ran into Darlene Gates, the CEO of MEG, at in an airport departure lounge or something, what would you say to her, Eric? Well, I'm chatting with her at 2:30 today. I think she's done a really great job. She and her team have done just a phenomenal job of making this company, along with Darren in his past role as the CEO. This is a very shareholder-friendly, very clean, very unique story that was going to reward shareholders very, very well over time. I think the timing on was out of her hands, courtesy of Adam Waters's actions, and so I think they did the best that they could. They got the best price they could at a time when sentiment still remains very challenged. This is a sector that bleeds money every single day. Every energy fund loses money on us every day as companies or investors are chasing Bitcoin and NASDAQ stocks. And so at a time when sentiment remains challenged, funds flow are negative, I think they did the best with what they could do. Eric, thank you very much indeed for joining us at short notice this morning. My pleasure. Eric Nuttall, partner and senior portfolio manager at Ninepoint Partners.